Hi folks, Chuck Gibson from Financial Perspectives in San Ramon, California with August 2017's Charts on the Move. Because Du Bois were on vacation, it was no surprise that August turned out to be as dull as it was. The S&P 500 closed the month out exactly 72 cents higher than it opened. And this was in spite of escalating tensions with North Korea, a Category 4 hurricane, and a Twitter firestorm in Washington, D.C. Stocks continued trading at near all-time highs. A market that refuses to go down will eventually go up, and that's exactly what's happening here. In all my years of investing, one of the most reliable signals comes from identifying what the market is not doing. Despite all the headline uncertainty, this market was not tumbling. That told me there was good support behind these prices, and the path of least resistance remains higher. That told us the latest drop in price was still a dip buying opportunity. But we still need to see the big money start buying once they're back from vacation to keep this rally alive. Being open to all possibilities, there's always the chance that Washington fumbles tax reform and the market uses that as an excuse to take profits. This could lead to a wave of reactionary selling. That said, this is a low probability event because our fumbling, bubbling government cannot get anything done, and expectations for tax reform are already probably quite low. I doubt many people will be surprised if nothing gets accomplished this year. That lack of surprise means we won't likely see much of a sell-off. If we were vulnerable to high expectations, we would have seen a much stronger reaction when the Senate failed to pass health care reform. This is an incredibly strong market that is ignoring every excuse to sell off. So we keep doing what's working. That is, until it doesn't. With that in mind, let's take a look at some charts. My first chart is that of the S&P 500. As you can see, we continue to print higher highs and higher lows, which we all know by now is the definition of an uptrend. Price sits above the rising 200-day moving average, and momentum is well within the bullish zone, continuing to stay above 35, even on the pullbacks. This is as sustainably bullish chart as you can get. While we don't focus on fundamental analysis, it's great when they're both aligned, which is why I continue to monitor the data in my next chart. It may look familiar as I showed this chart 6 months back. In the upper pane is a plot of the S&P 500 earnings in blue with a red 200-day moving average line added to help identify turning points. In the bottom pane is a plot of the S&P 500 price. The takeaway here is that there is no divergence as earnings continue to move higher in support of rising stock prices. At the end of August, biotech stocks caught a ferocious bid as the sector index broke out to new highs, spurred on the purchase of Kite Pharma by Gilead. If you haven't read the recent New York Times story called An Immune System Trained to Kill Cancer, you should. It tells a story about a man with leukemia who was nearing death but was cured by Novartis' CAR-T drug therapy. If you get a chance, find it online and see if it doesn't seem like a made-for-TV movie. It's quite amazing, really, and it gives you hope for our future, seeing emerging technology saving lives. As with last month, a big story for August was the dollar. It tried very hard to rally, but could only muster a whimper as it climbed up a pitiful 1.5% and then succumbed to further selling pressure, and then went on to make a new low. At that point, even the most optimistic technician threw in the towel and was forced to join the dark side. The dollar story was dead. But no sooner than breaking out to the downside, it immediately formed a hammer reversal candle and pierced back up through resistance, invalidating the breakdown. As we know, there's nothing more significant than a failed break of support or resistance. So it appears I need to go pick up my towel and continue to watch the dollar for its next move. I blog posted about the breakout in gold last Wednesday, wondering if it was real or just a fake out. With a couple of days more action under its belt, we can see it still holding above the breakout level, which is very constructive. It's nice to see it has had a successful backtest, which helps confirm this breakout is likely the real deal and is going to stick. As you can see here on Thursday, the price of gold fell back to test this breakout level and then immediately bounced higher, closing towards the high of the day. This, folks, is a beautiful example of a breakout and backtest. While constructive, this is not yet worthy of a buy signal as the upside is limited. Just above is a level of much greater resistance and a reason why I did not add this to clients' accounts. The risk-reward ratio did not meet my investment minimum guideline. A breakout above the mentioned upper resistance, though, would be worthy of investment capital. As you can see in my next chart, U.S. bonds continue to push higher in spite of the threats of their imminent demise due to the Fed promising to raise interest rates. Apparently, the bond market feels the Fed is bluffing and not convinced about the growth story that's coming out of Washington. Higher bond prices are indicative of deflation, not inflation. Someone's going to be wrong, though. Speaking of inflation, as is always the case, we see not all investors are aligned in their beliefs. Some shun the deflation story, believing the reflation thesis, and they think that the bond market has it all wrong. You can see this reflected in the price of industrial metals, which are a good investment proxy for inflation. Looking at one of the main needs in a growing economy, we see steel stocks are breaking out to the upside after a strong pullback on their way to testing 2013's highs. It's just not steel, though, that's marching higher. If you look beyond just steel at the base metals ETF, which holds an aggregation of all base metals, and this includes steel, copper, aluminum, zinc, etc., we see a very similar story to that of steel. Prices marching higher, just recently breaking above 2014 highs, with its eyes on the highs made in 2012. Price sits above a rising 200-day moving average, while momentum is very overbought. And that's a normal occurrence seen in a strong trending market. Soon, someone will be proven wrong, and those investors on the wrong side are going to be subjected to a healthy correction. You are witnessing a case of divergence in real time. With bonds sitting just under resistance and our inflation proxies above support and breaking out to new highs, it's likely they both can't continue to march in lockstep forever. If I had to vote in the near term, I have to join forces with the reflation crowd. For this reason, we currently have some client bond money sitting in cash as we see who will eventually win this tug of war. But long term, and until we can resolve our massive debt issue, deflation is the boogeyman. Well, I don't have a chart. I would be remiss if I did not mention current sentiment before I close out this video. Remember, sentiment is tough to measure, so one has to be careful not to read too much into its readings. Also, it is a contraindicator when it reaches extreme levels. Meaning, when sentiment is an extremely bearish reading, that is bullish for the market, and vice versa. The NAAIM reading was just published last week and came in at the lowest level in 5 months. The NAAIM number is the result of a poll of professional investment advisors and their equity exposure. The higher the reading, the higher their exposure to stocks. As they come back from summer vacation to find their portfolios lagging because of stock strength, they could be the fuel needed to push this market higher into the year end. With this reading so low, and considering the amount of money NAAIM investors control, it presents a potentially very bullish short-term outlook for stocks. Well, that's it for this month. So until next month, as always, I appreciate your time and your attention and hope you found this video informative and helpful. If you have any special requests for the next installment or comments, I'd love to hear from you. You can send me an email at chuck@financialperspectives.biz. Again, thanks for listening, and until next month, this has been Chuck Gibson from Financial Perspectives with August 2017's Charts on the Move.